Have you ever felt that frustrating sensation of watching from the sidelines as a stock you've been monitoring suddenly skyrockets in value? One day it's moving sideways, and the next it's making headlines with a 50% gain, leaving you wondering what invisible signal you missed. That moment of realization that you were looking at the right stock but somehow failed to see what was about to unfold is perhaps the most common pain point among traders worldwide. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Today, we're going to explore the hidden language of the markets through the revolutionary lens developed by Richard Wyckoff, a master who decoded the market's whispers decades before modern technical analysis existed. What makes his approach so remarkable is not just its effectiveness, but its timelessness. These patterns work today just as well as they did a century ago. The markets speak in patterns that most traders never learn to decipher. Like a poker player who hasn't learned to spot tells, the average investor misses the subtle indicators that telegraph the smart money's intentions. Has this ever happened to you? You analyze a chart, everything looks normal, nothing stands out. Then suddenly the price explodes. What did you miss? Wyckoff discovered something profound. Before any significant price movement, there's a period where institutional investors leave footprints as they quietly accumulate positions. These aren't random market fluctuations. They're deliberate actions by experienced players who know how to disguise their intentions from the untrained eye. What fascinates me about Wyckoff's methodology is how it transforms the seemingly random noise of price action into a clear narrative about supply and demand. Where most see chaos, the trained observer sees a methodical transfer of shares from the impatient to the patient, from the uninformed to the informed. Stay with me until the end of this presentation because I'm going to reveal the specific patterns Wyckoff identified. Patterns that appear on your charts every single day, telegraphing potentially explosive moves before they happen. These aren't theoretical concepts or back-tested strategies that only work in hindsight. They're practical, observable phenomena happening in real time across markets worldwide. What you're about to discover might surprise you. The most powerful signals aren't dramatic events that grab headlines. They're subtle shifts in market behavior that go completely unnoticed by the average trader. These quiet moments of accumulation create the foundation for breakouts that seem to come out of nowhere to the untrained eye. Imagine developing the ability to identify these pressure-building phases before they resolve into explosive movements. Picture yourself entering positions with confidence when others see nothing happening, knowing you're aligned with institutional investors rather than fighting against them. This isn't about predictive algorithms or complex mathematical models. It's about training your perception to recognize. Ready to master the market's hidden language? Hit subscribe now and join thousands of traders discovering what the crowd misses before major market moves. This perception shift isn't just another trading technique. It's a fundamental transformation in how you interact with markets. What makes Wyckoff's approach so powerful is that despite all our technological advances, the algorithms, the high-frequency trading systems, the artificial intelligence, the core patterns of human psychology driving the markets haven't changed in over a century. The same forces of fear, greed, hope, and despair that Wyckoff documented continue to create identical patterns in today's markets. When you study historical charts alongside modern ones, the revelation is striking. Human nature remains remarkably consistent. The tools we use to trade may have evolved dramatically, but the underlying behavior of market participants follows the same predictable rhythms. This consistency is what makes these patterns so reliable across different eras, different markets, and different instruments. Behind the scenes of every major market move is this hidden truth. Price doesn't move because of news or events as much as it moves because of the collective psychological responses to those catalysts. Wyckoff understood this profound reality long before behavioral finance became a recognized discipline. The journey from amateur to professional trader isn't about learning more indicators or strategies. It's about developing the mindset that separates the consistently successful from the perpetually frustrated, and perhaps the most. A counterintuitive aspect of this mindset is the importance of patience and selective action. In today's world of constant notifications, 24-hour news cycles, and instant gratification, the discipline to wait has become a rare and valuable commodity. Wyckoff observed that successful breakout trading isn't about constant activity. It's about waiting, sometimes for painfully long periods, observing silently until conditions align perfectly. Most traders fall into what I call the action trap. They seek the dopamine hit of frequent trading rather than the more substantial satisfaction of meaningful profits. They chase every tick, every minor movement, convinced that more activity equals more success. But consider this decision point that defines trading careers. Would you rather be in 100 trades with minimal gains or in 3 trades that fundamentally change your financial reality? The impact of this choice compounds over time, creating dramatically different outcomes for different types of traders. What changed Wyckoff's career wasn't finding more opportunities. It was becoming extraordinarily selective about which ones he pursued. This discipline to wait quietly while others frantically trade is perhaps the most underrated skill in financial markets. Now, I want to go even deeper into this topic by examining what happens in the market during these waiting periods that most traders find so difficult to endure. These seemingly inactive phases actually contain the most valuable information for those who know what to look for. If you've recognized this pattern in your own trading journey, the struggle between patience and action, write selective discipline in the comments below. When we look at what happens before a major breakout, we discover one of the most profound insights in trading psychology. Breakouts don't materialize out of thin air. They're not random events that strike like lightning. What I've discovered in studying thousands of charts is that before a stock can surge upward, it typically undergoes what I call the building phase, a period of consolidation where energy accumulates like a coiled spring waiting to be released. This hidden truth reveals itself in a very specific chart pattern. Price begins moving within a defined range, neither rising nor falling significantly. To the untrained eye, this looks boring, even meaningless. The chart appears to be doing nothing special, and this is precisely where the critical divergence between amateur and professional mindsets occurs. Amateur traders grow impatient during this phase. They see lack of movement as lack of opportunity and begin selling or shifting their attention elsewhere. Meanwhile, behind the scenes, something powerful is developing beneath the surface. Professional traders recognize this consolidation for what it truly is, the quiet accumulation phase before a potential explosive move. They're watching closely, understanding the transformation that's taking place as the stock builds potential energy. It's like watching pressure build in a dormant volcano while tourists walk away unimpressed by its current stillness. The revelation that changed my entire trading journey was understanding that these seemingly boring periods are actually where the most significant decisions are made. The quiet periods on a chart often speak the loudest if you know what you're looking for. This connects directly to a deeper understanding of market psychology. The Market is ultimately a reflection of human behavior en masse. Crowds consistently follow predictable patterns. They get excited together, frightened together, and perhaps most importantly for us as traders, they get fatigued and lose interest together. This collective psychology creates opportunities for those who understand its rhythms. A breakout represents that magical moment when the crowd suddenly recognizes what insightful traders identified days or weeks earlier. It's the tipping point. When awareness spreads rapidly, creating a rush of buying that propels prices higher. The beautiful symmetry of this process is that by the time the average investor realizes what's happening, the prepared trader has already established their position at much better prices. If you're serious about developing the rare skill of spotting early breakouts like Wyckoff, hit that subscribe button and join our community of perceptive traders. This perspective shift fundamentally changes how you view market movements. Instead of chasing momentum after it's already obvious to everyone, you begin looking for those quiet consolidation patterns where smart money is silently accumulating shares. You start to appreciate the calm before the storm, recognizing it as a period of preparation rather than boredom. What's fascinating about this approach is how it removes the emotional chaos that derails most traders. When you understand the building phase and the psychological patterns that drive breakouts, trading becomes less about reacting to price swings and more about anticipating the next move on the market chessboard. Now, I want to go even deeper into this subject by examining how to distinguish between false breakouts and the real thing. This distinction is crucial because the market frequently creates deceptive moves designed specifically to shake out impatient traders. If you've experienced that moment of clarity when you spotted a stock in its building phase before a major move, type "I see the patterns" in the comments below. Here's where the transformation in your trading begins to take tangible form. Many traders, even those with years of experience, repeatedly fall victim to what I call the false breakout trap. This costly mistake follows a predictable pattern. You spot a stock edging slightly above a resistance level. You jump in expecting the breakout, only to watch it retreat below your entry point. Frustrated and discouraged, you sell at a loss. And then, almost mockingly, the genuine breakout begins without you. This painful cycle repeats itself across markets worldwide because it exploits a fundamental weakness in human psychology, our eagerness to act and our fear of missing out. Behind the scenes, the market is constantly testing your resolve, throwing out these false signals like bait to see who bites. It's as if the market is asking, are you disciplined enough to wait for confirmation? Or are you just another impatient trader I can shake out before the real move begins? The revelation that changed my decision-making process was understanding that the market doesn't reward those who move first. It rewards those who move correctly. Being early isn't about jumping at the first sign of movement. It's about recognizing the difference between weak, unconvincing moves and genuine strength. So what does a real breakout look like? This is where the hidden truth emerges. A genuine breakout arrives with unmistakable force and conviction. It doesn't creep or edge tentatively above resistance. It surges through with purpose, backed by substantial volume that confirms real money is flowing into the stock. The price action feels different. There's a palpable energy to it that you can almost feel through the chart. Unlike its deceptive counterparts, a real breakout doesn't whisper, it announces itself clearly to those paying attention. It's like the difference between someone gently testing a door to see if it's unlocked, versus someone confidently pushing it open and striding through. True breakouts show power, pushing decisively through resistance rather than merely poking at it. What fascinates me about this dynamic is how it mirrors broader life principles. In almost every field of human endeavor, from business to art to relationships, there's this same distinction between tentative half measures and decisive action. The market simply makes this contrast visible in price and volume, creating a perfect laboratory for observing human behavior. Now let's explore one of the most reliable signals that smart money is quietly accumulating a stock. Before a major breakout occurs, there's a subtle yet profoundly revealing pattern that emerges. Price dips become increasingly shallow. Each time the stock falls, it quickly rebounds, often more rapidly than before. This isn't random market noise, it's the fingerprint of deliberate action. Think about what this pattern actually represents in the real world of market dynamics. When a stock dips and immediately recovers, someone is actively supporting that price level, creating a floor that keeps rising higher. This is the essence of accumulation. Large players with deep pockets are quietly building positions, systematically absorbing the available supply without drawing attention to themselves. They're not interested in fanfare or headlines. They're focused on methodically acquiring shares before the crowd realizes what's happening. The journey to recognizing these patterns represents a profound evolution in a trader's development, transforming how you view what most consider boring market action. If you've ever noticed a stock that seems to bounce back more quickly with each minor decline, type "I see the footprints" in the comments. These gradually rising support levels are literally the footprints of professional investors building their positions. Now I want to address a critical mindset shift regarding profit potential. One of the most transformative insights from Wyckoff's approach was understanding that a legitimate breakout often initiates an entirely new trend rather than merely providing a quick profit opportunity. This perspective completely reframes how we approach position management. The hidden truth is that most traders severely underestimate how far these trends can extend. They've been conditioned to take small, quick profits, selling far too early and leaving the substantial gains on the table. They see a stock move 10–15% and think that's a good trade, never imagining it might be just the beginning of a move that could deliver 50%, 100% or more. In reality, a powerful breakout can carry prices much higher than most would anticipate, particularly when it occurs after a lengthy period of accumulation. The journey of developing this patience, of learning to ride trends rather than scalping small moves, represents perhaps the most significant evolution in a trader's development. It requires overcoming the deeply ingrained fear that profits will evaporate if not taken immediately. It demands the courage to let winners run while managing risk appropriately. Behind the scenes of this psychological battle is the revelation that the truly life-changing returns don't come from being right slightly more often than you're wrong. They come from having the conviction to stay with the right trades when all your instincts are screaming at you to take profits. This is where the decision to develop patience creates exponential impact on your results. This brings us to one of the most nuanced aspects of Wyckoff's approach, understanding how the market deliberately creates illusions to deceive traders before major moves. The market operates with an almost uncanny intelligence, frequently creating false moves specifically designed to shake out weak hands. It provides just enough movement to create belief in a breakout, luring eager traders into positions, then swiftly reverses direction, leaving them confused and discouraged. This deceptive mechanism has been functioning for over a century. The actors may change, but the screenplay remains remarkably consistent. The profound insight that transformed my own trading journey was learning to recognize the distinctive character of these false moves. They typically appear timid and hesitant, lacking true conviction. The price might edge slightly above resistance, but the movement feels labored, as if it's struggling to maintain momentum. There's a tentative quality to the action that, once you learn to recognize it, becomes almost impossible to miss. In stark contrast, a genuine breakout charges through resistance with unmistakable force. It doesn't timidly test the waters. It dives in with purpose. The price action displays a confident character backed by significant volume and buying pressure that confirms real money is flowing into the stock. There's an undeniable vitality to these moves that separates them from their deceptive counterparts. If you've ever been caught in a false breakout only to watch the real move happen without you, type "never again" in the comments. This recognition often marks a turning point in a trader's development. This distinction isn't merely technical, it's almost philosophical in nature. It's about developing an intuitive understanding of authentic strength versus manufactured illusion. Behind the scenes, what we're really identifying is the difference between smart money moving with conviction and market noise designed to mislead the masses. Now I want to go even deeper into this topic by exploring how experienced traders develop the ability to assess a move's character, what Wyckoff called reading the tape. This skill represents perhaps the most subtle yet powerful aspect of breakout trading. When watching price action unfold, skilled traders notice whether a breakout seems lazy with thin volume, suggesting a false move, or vibrant with heavy volume, indicating a genuine breakout. The revelation here is that charts don't just show price and volume, they reveal intent and conviction. They tell a story about the hidden forces driving market movements. Learning to read this narrative requires a mindset shift from seeing trading as merely technical to understanding it as psychological. The real journey involves training your perception to recognize these subtle qualities that most traders completely overlook. This skill doesn't come from formulas or mechanical rules. It emerges through observation and experience. It's about developing a feel for the market's rhythm and character, understanding that real breakouts have a distinctive quality visible in the trading activity. Some describe it as an almost artistic sensibility, the ability to recognize authenticity amid the market's constant noise. The transformation happens when you begin to perceive markets, not just as data points, but as expressions of collective human behavior. Each candlestick, each volume bar, each price movement carries within it the psychological imprint of thousands of decisions being made simultaneously. The trained eye learns to decode these signals, separating meaningful action from random noise. If you've been watching markets for any length of time, you've likely noticed that prices rarely move in straight lines. They ebb and flow, creating a series of highs and lows on the chart. What most traders miss, however, is the profound insight hiding within this simple rhythm, specifically in the pattern of those lows. The higher lows pattern represents one of the most powerful indicators before a breakout. When each price dip stops at a higher level than the previous one, creating a stair-stepping pattern upward, it reveals something extraordinary happening beneath the surface. This isn't random price action. It's the unmistakable signature of strong hands supporting the stock. It's like watching the tide gradually rise, each wave retreating less than the one before. Think about what this pattern actually represents in the real world of market dynamics. Someone with significant resources is deliberately stepping in to buy whenever the price dips, and they're willing to pay progressively higher prices to accumulate their position. This isn't the behavior of uncertain retail traders. It's the methodical action of knowledgeable investors who have conviction about where the stock is headed. If you've ever noticed this pattern of higher lows forming before a major move, write "I see the staircase" in the comments. It's that stair-stepping pattern of rising support that often precedes the most explosive breakouts. Behind the scenes of these rising support levels is something fascinating that often goes unrecognized. At its core, market movements frequently represent something much more fundamental: the transfer of shares from nervous holders to confident ones. This psychological dynamic plays out visibly on your charts. If you know what you're looking for, when dips are bought quickly and support levels consistently rise, we're witnessing a fundamental shift in ownership. Weak hands, typically retail traders and short-term speculators who lack conviction, are selling at the first sign of hesitation. Strong hands, professional investors with deeper pockets and longer time horizons, are methodically absorbing that supply, building their positions patiently and methodically. This transition in ownership creates a powerful imbalance in the market structure. With each transfer, the available supply of shares diminishes while demand continues to build. This tightening spring cannot remain compressed forever. Eventually, the remaining sellers are exhausted, and the stock has no choice but to resolve this imbalance through higher prices, often explosively higher. The journey to recognizing these patterns represents a profound evolution in a trader's development. Most never progress beyond looking at obvious resistance levels or headline news. They remain blind to these subtle yet powerful ownership shifts happening right before their eyes. But once you train yourself to see them, they become almost impossible to miss. This brings us to another profound insight that often goes unnoticed by even experienced traders. The speed of recoveries after price dips provides critical intelligence about what's really happening behind the market curtain. In weak stocks, lacking institutional support, declines tend to persist. The price drifts lower and stays there because few buyers have genuine interest or conviction. The recovery, if it happens at all, is sluggish and uncertain. But in strong stocks primed for breakouts, something dramatically different occurs. Dips are remarkably brief as buyers quickly step in, sometimes within minutes or hours of the decline. The revelation that changed my perception of market dynamics was understanding that these rapid rebounds aren't typically retail buying. The average trader simply doesn't react with that kind of speed and conviction. What we're witnessing is large players with strategic intent ensuring prices don't fall too far before they've completed their accumulation phase. It's like watching an invisible hand reaching out to catch the stock whenever it starts to slip. This insight offers a window into the mindset of professional traders. They're not concerned with daily noise or minor fluctuations. They have a thesis about where the stock is headed, and they're systematically building a position to capitalize on that view. The speed with which they defend their accumulation zone reveals both their conviction and their urgency. They don't want prices to fall too far because they're still buying. The hidden truth here is that you're literally watching the footprints of professional capital at work. These aren't random price movements, but deliberate actions by strategic players with substantial resources and well-defined objectives. Learning to recognize these patterns transforms how you perceive market action. If you've noticed this pattern where certain stocks seem to bounce back almost immediately after every dip, type "I see the invisible hand" in the comments. What you're recognizing is one of the most reliable indications that smart money is at work. Now, I want to address perhaps the most fundamental principle that separates consistently profitable traders from the perpetually frustrated majority. The essential difference lies in positioning before the crowd rather than after it. This isn't just a technical distinction, it represents a complete paradigm shift in how you approach markets. Early entry doesn't mean blind guessing or reckless speculation. It means developing the perceptual awareness to recognize strength building before it becomes obvious to everyone else. It's about training your eye to see the fingerprints of accumulation while the crowd remains oblivious. The higher lows, the quick rebounds, the quality of the price action. Professional traders don't wait for news headlines or analyst upgrades to confirm what they already see in the price and volume patterns. They don't need external validation because they've learned to trust the story the market itself is telling. They recognize the signs of strength developing while others remain distracted by noise, allowing them to establish positions before breakouts occur, not after them. This approach represents a profound Transformation in trading psychology. Most remain forever stuck in reactive mode, always one step behind the market's movements. They buy after the breakout is obvious, after the crowd has already pushed prices higher, after the best entry points are long gone. The pathway to consistency requires evolving beyond this reactive mindset into a more perceptive, anticipatory approach. Behind the scenes of every trading decision is a battle between emotion and analysis, between impulsive action and disciplined patience. The journey from amateur to professional doesn't happen overnight. It unfolds gradually as you develop the rare ability to see what others miss until they finally see it too. This perceptual edge becomes your greatest asset in navigating markets successfully. Now, I want to go even deeper into this topic by exploring how these patterns aren't just technical indicators, they're windows into the psychology driving the market's most significant moves. The patterns we've discussed, the higher lows, the quick rebounds, and the character of price movement, offer profound insights into how professional investors operate behind the scenes. These aren't random fluctuations or meaningless noise. They're the visible manifestation of human decisions being made by market participants with varying levels of knowledge, resources, and time horizons. When you learn to read these patterns correctly, you're essentially developing the ability to see the invisible hand of smart money at work before its presence becomes obvious to everyone else. The revelation that transformed my understanding of markets was recognizing that technical analysis at its best isn't about indicators or oscillators. It's about developing an intuitive feel for the psychological forces driving price action. It's about learning to recognize the footprints of conviction, uncertainty, accumulation, and distribution as they appear on your charts. This deeper perception doesn't just change how you trade. It fundamentally transforms your relationship with markets. You begin to see order where others see chaos, patterns where others see randomness, and opportunities where others see nothing at all. If you've experienced that shift in perception, where you started seeing the market as a reflection of collective psychology rather than just price and volume, write, "I see the invisible forces," in the comments. The truth is, what we've covered today isn't just about trading. It's about developing a deeper perception, an ability to see what others miss. It's about training your eye to recognize the footprints of smart money before the crowd catches on. These insights have transformed not just my approach to markets, but my entire understanding of how professional investors operate behind the scenes. I hope these principles from Wyckoff's playbook have offered you a new lens through which to view market action. The patterns we've discussed, the higher lows, the quick rebounds, the character of price movement. These aren't just technical indicators, they're windows into the psychology driving the market's most significant moves. If you found value in these insights, I'd genuinely appreciate it if you'd hit the like button. It helps others discover this approach to trading that has stood the test of time for over a century. And if you want to continue this journey of market mastery with me, consider subscribing for more deep dives into the psychology and strategies behind consistently profitable trading. I'm curious, which of these principles resonated most with you? If you've made it all the way through, type "I see the invisible hand" in the comments. Your perspective adds tremendous value to this community of serious traders we're building together. For those ready to go even deeper, I've created a video that perfectly complements what we've covered today. It explores how to manage your positions once you've spotted these early breakout signals. Click right here and join me, there to complete your understanding of this powerful approach to the markets. Remember, the difference between average results and extraordinary ones often comes down to seeing what others don't, until they finally do. I'll see you in the next video.